Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 304 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Nick Whitaker is joining me once again for the second week in a row, filling in for Matt. So thanks for hopping in here for 2 weeks straight now, Nick.
Always good to be here. Get a good run in.
Yes.
Two consecutive weeks.
Well, before we get started, I do have to show you and Jenna a picture, and maybe Jenna can put it up on the YouTube video. But this is a picture of Mia from daycare earlier this week, where she learned how to apparently cross her legs and cross her arms and give a death stare into the camera.
Oh, wow.
So there's just a load of sass in that.
Very mature.
In that picture, Jenna's seen it. So Jenna will try to put it up. I'll send it to Jenna, and she can put it up on the YouTube page for those that are curious. But the amount of sass is reaching a new level that I don't know how to handle. And she's gonna be 2 here in August. And I know you have a niece of around a similar age. So. Yeah. That's the parenting stuff that we're dealing with at this point in time.
That's wise beyond her years.
It is.
You don't see many 2-year-olds picking up that many levels of body language, sass, as you put it.
Yeah,
it's pretty good.
It's scary how smart she is sometimes, but. But before we get into it, if you have been enjoying the Independent Advisors Podcast for a while now and would like to take the next step in your financial journey, I would encourage you to head to our website, jessupwealthmanagement.com. Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at jessupwealthmanagement.com, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts and as of the market close on June 11th. S&P 500 index up 1.9% for the month of June and up 2.4% for the year. The Dow Jones Industrial Average up 1.4% for the month and up 0.8% for the year. The NASDAQ Composite Index up 2.6% for the month and 1.6% for the year. The Russell 2000 Small Cap Index up 4.2% for June and down 3.3% for the year. And the Vanguard All World ex-United States ETF up 2.2% for the month and up 16.2% for the year. 3-month Treasury rate at 4.45%, the 2-year Treasury rate at 3.94%, and the 10-year rate at 4.41%. Moving on to big headlines and current events from this past week, Nick, I think the big news headline was the President Trump-Elon Musk feud that played out in the media, where Elon publicly criticized Trump's One Big Beautiful Bill Act, which is a substantial $1.6 trillion legislative package. So Elon denounced the bill for increasing the federal deficit, cutting health care for the poor, and removing electric vehicle subsidies, which I think that last piece was the key part of that. But Trump responded by accusing Musk of opposing the bill due to the elimination of the EV subsidies that would obviously affect his company Tesla, and he threatened to cancel federal contracts with Elon's companies. So personally, think it's more bark than bite here. I mean, it seems like they're already kind of saying sorry and kind of getting close again. But it did, have a short impact on the market and Tesla specifically last week. But Tesla has already actually bounced back pretty substantially. So in my opinion, it's really a nothing burger. But I'm sure people and listeners have heard about it. But I don't really think it's something that you need to be paying attention to as in regards to your portfolio. So.
Yeah, agreed. I think just a lot of rah, a lot of news headlines, entertaining for sure. But yeah, I wouldn't stress about it.
No, I don't think so. Next, CPI. So total CPI was up 0.1% month over month in May, and core CPI, which excludes food and energy, was up 0.1% month over month as well. The key takeaway here from this report is that both CPI numbers were lower than expected on a month-over-month basis. So while these readings may not give a huge boost to near-term rate cut expectations, they also shouldn't really cause the market to think that the next cut will be delayed. So inflation for the time being is staying tame. And then last but not least, over the past couple of days, President Trump announced that a trade deal with China has been agreed upon. There hasn't been anything substantial come out about it or any details released about it, so we'll have to wait and see. But Trump and several people in the administration said that there was a trade deal that was reached. So that would be very important to the market going forward after everything that we went through here in early April. So
yeah, and I'll just jump in there and tell listeners, don't be too surprised if you don't see a lot of price movement out of that announcement. It would be pretty normal for the markets to just kind of take that in stride, and you'll see, a small move, up or down, because this has been priced in that they were going to come to a resolution that wasn't going to rock the markets. So I'm not saying that that's guaranteed. The market still could react in a more significant manner. But just saying, don't be surprised if it's kind of a nothing burger for the markets.
Yeah, exactly. And it's kind of funny how, the news cycle works in combination with price. It's like, okay, we just got a China trade deal done, and would you look at it, we're sitting right around all-time highs, right? Mm-hmm. So it's like, even though people might think that this is going to send stocks to the moon, like you said, you got to remember this stuff is priced into the market, and the recovery that we've seen since the low in April has priced that into a certain extent.
Yeah, absolutely.
So first thing I had was in terms of tweets, articles, and research from this week was a post on X from Kalshi on June 2nd. So quickly before I go over this post, Kalshi, for those who might not be aware, is a U.S.-based federally regulated prediction market that allows individuals to trade on the outcomes of real-world events through what they call event contracts. And these contracts function as just binary options. So you can either say yes or say no to the question that is being asked. So Kalshi, like I said, on June 2nd, put a post out on X saying recession odds have fallen from 70% to 31% in the past month. Jenna will throw this chart up on the YouTube page, but as you can see, back in early May, I guess you can't really see it on this chart, but back in April, recession odds were up around 70%. And then as the market recovered and as the tariff pause went into effect, you can see the odds of a recession drop substantially. So I just thought that this was interesting because these are people out there that are just betting on a binary outcome. Do they think there's going to be a recession, or do they think there's going to be no recession? So just thought it was really interesting, and I'd be curious to see what this chart does on this question over the next couple of months when the tariff pause actually is lifted, which is in early July. So for those who have forgotten already, the tariff pause was for 90 days, and I believe it's the second week of July where that tariff pause ends. So yeah, thought it was interesting. I've never taken part in any Kalshi event contracts before. I know people who have, but you can bet on pretty much just about anything these days. So
yeah, it's interesting, and I think for any listeners who are thinking, okay, well, what's the 31% if the tariffs are getting worked out? The 31% is really thinking about where the economy is going to go from here when you look at inflation, when you look at growth projections, in light of what's happened to inventories over the past couple of months with the tariff impacts, as well as the future conversations about the treasury markets and the debt. So it's more obviously looking at the next few months will be pretty big from an econ data perspective. The CPI print that you mentioned this morning was a step in the right direction, but there's still a lot of argument on the street that, hey, we're not seeing it in the data yet, and that we could see it in the next couple of months, which might shake up this chart a little bit. So we'll see what happens from here.
yeah, and the reality is that there's always going to be a greater than zero chance of a recession, right? There's never going to be a 0% chance that we're not going to go into a recession. So, and that's just with the unknowns in the world that we live in. It could be a war that breaks out that no one's expecting, or it could be the Fed doing something with interest rates that nobody expected, or inflation reigniting again, or going into a deflationary period. So there's so many different things that could throw a specific country into a recession, or things that could throw the global economy into a recession. But those risks are always there, pandemic, right? So moving on, second thing I had was just a quick chart from a blog post from our friend Ryan Dietrich at Carson Group. This was back on May 30th. The post was titled, "Why a Strong May Could Have Bulls Smiling." Jenna will throw this up on the YouTube video. It'll also be in our show notes. But essentially, this chart from Ryan's blog post shows the S&P 500's performance 1 year after a monthly gain of 5+%. So for each month, so all the 12 months, it shows how the S&P 500 performed a year after there was a gain in that single month of 5% or more. And the interesting thing here, Nick, is the month of May has the strongest future returns out of every other month, with 100% positive hit rate 1 year later and average gains of just under 20%. So again, not saying that the future is going to exactly play out like the past, but usually when stocks, are strong in May, there tends to be good things coming over the next 12 months.
Yeah, it's a nice chart to see for sure.
So, and again, it's just interesting. You can go and see, kind of the strongest months and the forward returns associated with that. But May is 1 out of 12 on that list. So I think as Ryan's blog post was titled, this should give investors a smile on their face, at least for the next 12 months. Lastly, I had another post on X from Steve Deppe, who is a CMT, on May 30th. Jenna will also throw this on the YouTube page. He says, "Random, when the S&P 500 ends a 3-month losing streak by gaining 5% or more in month 4, like we just talked about, Nick, that was May, the index has been up and away. This guarantees us nothing, but it's generally best to position as if this time is not different while being prepared in the event it actually is." So just to kind of explain this a little bit further, S&P 500 was down in February, March, and April this year. And that 3-month losing streak ended last month in May. So this has only happened 11 times in history, and 1 year later, the S&P 500 has never been negative, and the average 1 year gain has been a little more than 20%. So this actually coincides pretty nicely with the data that Ryan shared in that blog post I just talked about. So again, it could always be different, and there could be something that comes up within the next 12 months that rocks markets. The data just says, it's not very likely, right?
Yeah.
So again, this amount of, or this pile of bullish data, just in my opinion, continues to pile up and up. When you look out, 12, 18, 24 months, obviously anything can happen within the next couple of months, but I do think the data that we're seeing right now suggests that the worst of it could be behind us in terms of the selling. So with that, I will turn it over to you.
Yeah, sure. The first thing I have is research from briefing.com. Their research piece that is recurring, it's called The Big Picture, which is discussing why the May jobs report eased economic fears. The labor market remained resilient. Unemployment and wage growth support continued economic growth. The May job report eased fears of economic recession. A resilient labor market reduces the probability of an imminent Fed rate cut. That was kind of the headlines there. I'm going to read just a quick little section here. Non-farm payroll growth may be slowing, but it isn't declining. Average hourly earnings growth may be slowing, but on an inflation-adjusted basis is still positive. The unemployment rate may be up from a multi-decade low of 3.4%, but at 4.2%, it is still historically low. The most important takeaway is that the combination of the low unemployment rate and the higher than expected average hourly earnings growth, which follows a robust 0.8% increase in personal income in April, will keep consumers on the spending path and the economy on a growth trajectory. Just a one caveat, that's all good news, and that we saw on it from the jobs report. Just one point that, to play the devil's advocate, that you'll hear, maybe percolating in some deep corners of the web, maybe not so deep corners of the web. The vast majority of non-farm payrolls, so think the jobs report, increase in May was driven by two industries, healthcare and social assistance, as well as leisure and hospitality. So those are two areas, particularly leisure and hospitality, that can move somewhat quickly. So that is one kind of small piece of it. But the takeaway here is that the economy is still very healthy when you really look at everything. Yeah, inflation's a little high, but it's been trending lower, and it's just half a percent or a little bit more above the 2% target, and the unemployment rate is still very healthy, under 5%, which is the dual mandate. So things are still doing very well when you look at the hard data.
Yeah, and add the labor market to another thing that could throw an economy into a recession, right? If you are going to have I don't know if a strong but a prolonged recession, you're going to see that in the labor market, right?
Absolutely.
You're going to see the unemployment rate tick up. You are going to see wage growth be non-existent.
Right.
And the fact of the matter is we're not seeing those things right now. So
right. And when we say unemployment numbers pick up, we're not talking 3 to 4%. We're not talking 4 to 5%. We're talking much higher above that 5% target. There's a reason that the Fed targets 5%. And that's because, due to hundreds of years of studies of economics, that is the a realistic rate with turnover in the economy.
Right. Right.
So more good news there. My next two pieces are a little bit more maybe pessimistic, you could say. The next piece is executives turning more pessimistic. It's from a Bloomberg research piece on the 4th. Titled U.S. Business Optimism Slumps and Clear Pivot from Trump Election. Only 27% of executives polled in May are confident about the economic outlook for the next 12 months, down from 47% in the fourth quarter and 67% in the fourth quarter. 1 in 5 business executives believe the U.S. is already in a recession. That's interesting to me. I don't know how. We'll talk about that in a second. While the other 34% expect one by the end of the year. with 75% of those expecting a recession predicting it will be moderate to severe. So this is a smaller study, but it's done by the Association of International Certified Professional Accountants. So the Q2 survey was conducted from May 5th to May 27th and includes 328 qualified responses. So they're not just grabbing anyone off the street, is essentially what that means. So interesting. I always tell people to be careful with data and the underlying data, and this is a small data set. So I wouldn't get too worked up. I'm not throwing this out there to get people worked up. It was more just, well, that's interesting.
Yeah, and Matt and I always say we're not too big of fans of surveys in general, because this actually, I'm glad that you brought this piece up, because this directly conflicts with data that I've seen over the past couple of weeks that corporate insiders and corporate executives are buying stock hand over fist right now, right?
Yeah.
So, and both of those things can be true. Let me be clear. You can, telling people how you feel about something versus what you're actually doing with your money can be two separate things, right?
Yeah,
so both of these data sets can be correct. But I think just people need to be careful with surveys like this, and more focus on what people are actually doing with their money, because anything can influence the decision or the answer to a survey on any given day, right? Someone's having a bad day or had a really tough week at work, yada yada. That can influence what their answer is in this survey. So. I'm with you. It doesn't really concern me, and I'd love to talk to some of these people and see what data they're looking at that they think some of them think we're already in a recession. So,
and thinking about when the data was put out there between May 5th and the 27th. That was still a little bit more of a volatile time. I know it was only a few weeks ago, but there were still some questions, particularly around the data side and in the economy. And since then, we've had some CPI prints and some more signs that there's a little bit more health under the economy. So anyway, I just wanted to throw out another counterpoint. Trying to give you both sides of the coin out there. So the third thing I have is another article I picked up from Bloomberg on the 7th of June, which was titled, "Corporate Cash Levels Are Starting to Fall." Cash levels at blue chip U.S. companies, excluding the most cash-rich corporations. I'm going to repeat that. Excluding the most cash-rich corporations have fallen nearly 1% compared to the last 3 months of 2024, sparking concerns about credit quality. While the biggest cash generators, such as Meta and Microsoft, have seen their cash holdings rise, leverage levels for many high-grade companies has been better about 80% of the time over the last 2 decades. That's according to a Bloomberg News analysis that focuses on non-financial companies with less than $30 billion of cash. And the comments there on Meta and Microsoft are not a advertisement for or against either of those names. Compliance hat on. So we'll throw a chart up here, and it's an interesting chart. It's an interesting article and comment, but the overall level is not as bad as mid-2022, which is notable for me. When you look at the chart, okay, sure, it's trending a little lower over the past few quarters, but not aggressively lower, and it's nothing that really is... I read the article because it was interesting, and then at the end of the article, my thought was, okay, yeah, we'll see. Mm-hmm. I don't know. What are your thoughts on this?
Yeah, I think it kind of just goes to show that there's more options out there to return money to shareholders than just having a huge cash pile, right?
Right.
Apple's been a target of this for a long time, right? Having hundreds of billions of dollars in cash.
Right.
So I just think that people or companies, have, things that they are doing that over the long term are going to return more money to shareholders, rather that, if that's paying special dividends or buying back stock or, reinvesting back into the business. They're choosing to do that rather than just build their cash pile. And to me, that's a positive thing. I think it'd be more concerning if cash levels were rising substantially, because that tells me that there's indecision from a leadership level on the specific company. And then if you see a lot of companies doing that on the economy and the market itself. So I don't see any issues with that. I think it's better than having hundreds of billions of dollars sitting on the sidelines.
Yeah, could also be a bit of a fear gauge as well.
Right.
When you're stocking cash, you don't quite know what the future holds, and maybe that's why we saw a bit of that cash stack up kind of in the beginning of 2023. You see that trend a little bit, but since then, I've spent some. There's also, I imagine, if you really pull this out, probably on a 10-year basis, I'm sure there's a cyclical nature to it.
Sure.
To some degree.
Yeah,
so I don't know if you can get a great sense of the cyclical nature by just looking at 5 years. As strange as that may seem, and you're only looking at quarterly data points, and you need more data points to really be able to see that. So that's another piece of it as well.
Right.
So
right.
Interesting nonetheless. But again, those are two slightly more negative connotation stories that I'll throw out there and put some context behind it. Hopefully that helps listeners think through it.
Well, yeah, I don't think we'd be doing our jobs if we weren't looking at things from both sides. I mean, yes, we are, I would say, bullish or optimistic most of the time, but it's just because the reality is the market's up on average 3 out of every 4 years. So, why wouldn't we be? But it's important to see, to poke holes in that thesis and see where things could go wrong. So I always appreciate the stone wall or the steel manning of certain topics. Moving on to the financial planning topic of the week. This was a post on X by Nick Majuli on April 28th. So he says, retirement income hack, pay 0% in federal taxes on up to $126,700 in income from a taxable brokerage account. Taxable brokerage account, meaning it is a joint investment account, an individual transfer on death account. This is not a retirement account, okay? So the catch, you have to be married. The income must all be long-term capital gains, and you can't have any other income. Taxable brokerage accounts are underrated, which I wholeheartedly agree with Nick on. Everyone talks about retirement accounts and how beneficial they are, but I really do think that taxable individual and joint accounts are very underrated. So how does this work in theory, Nick? So the long-term capital gains tax rate for married couples in 2025 filing a joint tax return is 0% up to $96,700 of long-term capital gains. And for an investment to be qualified as long-term capital gains, you need to have held it for at least 12 months or longer, to where when you sell it after holding it for at least 12 months, you get a preferential lower tax rate rather than just paying the ordinary income tax rate on it.
Yep.
The standard deduction for a married couple filing a joint tax return is $30,000. So you can have $30,000 in ordinary income and pay no taxes on that income. So for those that may not know, the standard deduction is a set amount of money that the IRS lets you subtract from your income before you figure out how much tax you owe, right? It lowers your taxable income, which means you could end up paying less in taxes, which is a good thing. So $30,000 of ordinary income, which is wiped out from the standard deduction, plus the $96,700 in long-term capital gains gets you to that $126,700 of income number that Nick was talking about, all with paying $0 in taxes. So this is achievable. but you have to you have to know that and have several years to plan for that, right?
Yeah.
So it's great that we know this information, but if I'm talking to somebody who's 70 years old and really only contributed to an IRA or a 401k throughout their working career, then this isn't really going to work for them. So I think getting this out there, that yes, we should be prioritizing retirement accounts, but also we shouldn't be forgetting about the non-retirement investment accounts, because down the road, as an advisor, I can help people manage their tax bill a lot easier in retirement if they do have a taxable brokerage account.
Absolutely. And the other nice thing is so this is probably for the younger generations of listeners out there. The other good thing about that is if you can diversify your savings somewhat, to where, of course, you need to be contributing to your retirement plan, be it an IRA, a 401k, et cetera, and you have a bank account and you're saving to your bank account. But if you can also take a portion of that and start saving into a brokerage account or a taxable account, when you look at that over a 20, 30-year period, obviously you're invested in the market, and you can benefit in the market from that account at a higher rate, historically speaking and statistically speaking, than your bank account's going to pay you. But what's nice is, maybe you can use that pocket of money to help you buy a car, to help you fix your air conditioner, which I did recently.
Yeah.
Things like that, and you're just paying a capital gains tax, as opposed to getting hit if you needed that money to pull out of an IRA. You're going to have to pay a big penalty.
Yeah.
So that's another way that you can use it, kind of while you're growing it, in anticipation for when you retire. You can also use that capital,
Yeah.
so it's available to you,
Right.
Whenever.
Yeah, it's a good point. It's, you can contribute as much money as you want into it every single year. You can pull as much money out of it as you want every single year. There are no penalties. Like you said, if there's a gain, you'll pay the tax. But if there's a loss with the investment that you sell, then you don't pay the tax, right? So yeah, very, very, very nice tool. We do have a listener question this week from
right.
Dennis Nick. So this is the first one in a while. So he says, for me, it's corporate bonds and the inverse relationship of price and yield. If I think of yield, the higher the better for income purposes, but that means price is going down. Which is better, price or yield going up? So I think it's a great question, Dennis. And, kind of like in our industry, it's not going to be a clear-cut one answer, right?
Yeah.
So Dennis is right that the bond prices and yields move in opposite directions and have that inverse relationship. But I think the way to think about it, Dennis, is that if you already own bonds, you want prices to go up, meaning yields are falling. And that's because if you sell your bond before maturity, for example, you can sell it at a higher price. And also, bond prices moving up makes that portfolio statement look a lot better, right? Mm-hmm. Because your portfolio is just going to have a higher value at month end, quarter end, year end, right? Yeah. But if you're looking to buy new bonds, I think you usually want yields to go up and prices to fall, because higher yields mean you can buy bonds today that pay more income relative to what's been available recently. So let's say, the Treasury is issuing bonds today with rates where they're at today. And let's say next year in 2026, the Fed raises rates by 1.5%. Well, guess what? In 2026, the government's going to be issuing bonds that are at much higher rates, giving people more yield, right?
Exactly.
So I think it really depends if you are a bond holder or you are someone looking to buy bonds. Right. But just generally, the way I think about it is, if you are a income investor or a dividend investor, or you are investing in the market to get a monthly distribution of income, or quarterly or semi-annually, you want yields to be higher, right? Because then your income that you're receiving is going to be higher. And if you depend on that income for your living expenses or whatever you want to do with it, then you want yields to go up, right?
Yep.
But if you're not that, and I would argue the majority of investors are not that, then you want prices to go up. And like me and you were kind of talking before the show got started, Nick, there's been multiple years where bonds have had double-digit returns back in history, right?
Absolutely.
So I think it just goes to show you that, the adage or the misconception that bonds just generate a yield or interest rate that gets paid to investors and the price just stays at par its whole life is not true.
Right.
And we saw that back in March of 2020 during COVID. These corporate bond prices, swung wildly, right? And they were short-term dislocations in the market that actually, looking back on it, provided opportunities to buy a bond from a really good company at a steep discount.
Yeah.
And people were rewarded for that.
At a cheap price.
Yeah. So I think it depends on what your goals are, Dennis, and where you are in life. But that's how I would think about bond prices and yields in that sort of inverse relationship.
Yeah, the only thing I'll add there is I think from my time in wealth management, I think there's a lot of focus, and maybe just in the retirement community in general, there's a lot of focus on yield, even on the equity side of things. The dividend yield and all this company's playing, this product or this company is paying such a high yield. And one of the cautions that I've had in the past when talking to investors is capital appreciation is a big deal as well. And like you said here, when you buy a bond at a good discount, you can make some good money on the capital appreciation, and that can really show in the market value. The bonds are marked to market as well. So, it depends on, as you said, it depends on your purposes, but, don't be afraid of a bond just because there's one that has, 0.5 of a, of a percentage more in yield, right?
Yeah. And that's the one of the very few things I hate about our industry is there never is, I won't say never, but more often than not, there's not just one straightforward direct answer. It depends on a lot of different variables. So
which is why it's a great question. So thank you, Dennis.
Yeah,
for
hope
asking
that helps. Well, I think we'll leave it there for the day as we are out of time. Nick, anything else before we sign off for the week?
No, that was everything for me. Hopefully everybody is enjoying the summer and gets outside, enjoys some nice weather.
Yeah. Hopefully everyone gets some time to watch the U.S. Open golf tournament at Oakmont. I know I will be watching this weekend, so hoping to see some high scores and some carnage and just show that professional golfers are real humans too.
Lots of chunk out of the rough. It's going to be fun.
It's our type of game. Well, thank you for listening to episode 304 of the Independent Advisors Podcast. We will be back with you next week for episode 305.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.